Jack, it's all you, man. I'm gonna get this going for you on here too.
You got me all set up already, huh?
I do. Set up on here.
Oh, I heard you guys. Can I steal your dry erase chair?
Yes, I'm done with that. You can erase it. Yes. Right.
Thanks, Sharon.
You are welcome. Is the Ignite sign here somewhere? Back there. Okay, perfect.
Are we in the right Zoom session?
You are in the right Zoom session. I just set you up. You're all set and it's recording. You're all good to go.
Excellent.
And the best way to erase that is with that spray right there.
Okay.
You good to go?
Sharon, you make a mess of this thing or what? You don't like it?
So,
Yeah, you look through there.
All right. Cool. Good. All right. So I think we're gonna need microphones, I'm guessing. Or at least one extra one for you or whoever. Whichever one. But you're gonna have to stand over here, JR, so people can see you. All right, so I think we are right on time. It's 2 o'clock. I don't know, how many people do we have on line? Just 2? Okay, which is fine. Let's see here.
Hi, Jack.
Hello. Hey, guys. All right, cool. All right, so it was interesting about a week and a half ago, one of my partners, Jason, I was sitting with him. He's a newer agent on our team. And he had started asking me, we were having a conversation about 1031 exchange. And I think John had asked some questions also. Anyhow, I thought it'd be a good opportunity to have kind of an in-depth conversation on 1031 exchange, not your typical dry, although some of it could end up turning dry possibly. Conversation about, 1031 exchange, how we encounter it. Also how it plays out in the big picture of how we work with clients and how they can leverage it. So it's kind of like a big real estate agent's big picture, but also valuable so you can hopefully feel comfortable presenting the information to your clients in a way that they can interpret it, but you don't also get yourself in trouble, right? Because I'm not a CPA, I'm not a tax attorney, I'm not an estate planner, but I've had I've been doing this for a long time, almost coming up on 30 years now. And during the course of that, 13 years of that, I spent as a mortgage advisor, which put me on the financial end of a lot of people's tax returns on how they handle real estate. And I got to have the fortune to actually learn from a lot of these experiences, looking at people's tax returns and how they go about getting wealthy, and even poking them for tips and questions and what they've done. And it's interesting to see that, actually expressed in terms of real estate and have that knowledge to bring with me to here. So I wanted to share all that with you guys, with our team. And also the reason JR is here with me today is because he's had a passion about real estate investment that preceded his interest in real estate. So he's actually, and of course he owns real estate outside of his primary residence. And as do I, have investments. So he's had personal firsthand experience with it. Plus he's studied it. He's taught it to clients on numerous occasions. And when I have questions about ideas or thoughts, he's the guy I turn to. So that's why JR's here. So anyhow, so I guess to kick off the participation, I mean, let's start with you guys. What is 1031 exchange? Does anybody have an idea of what that is?
Dollars into another property so it doesn't get taxed. Oh, sorry.
You're rolling like your equity dollars into another property so it doesn't get taxed. Kind of the shorthand of it.
Yeah.
That's a good description.
Yeah, 1031 actually refers to the federal tax code. So it's actually the tax code that's written. That's 1031 is the number of the actual tax code. So why would somebody want to do a 1031 exchange?
Because you could be crushed by capital gains tax if you liquidate a property as well.
Okay. Elaborate on that.
Well, let's say you buy the property for 300,000.
Oh, he needs a mic.
Right, it might not.
Sorry about that.
Let's say you bought a property.
Yeah, it's, you know, it's on it. Can you guys hear online?
Hello?
Yes, I can hear you.
Okay, perfect.
Okay, so let's say you bought a property for 300,000 and you sold it 5 years later for 600,000. You have a $300,000 capital gains that you have to pay tax on, which is what, 15%? I'm not sure on rental property.
So, yeah, it's, well, you've kind of got, with regard to taxes, we'll get to that again, because that's, I mean, that's another reason 1031 exchange is so important, the taxation, but there's a game to be played with it. But yeah, the federal, it seems like ranges, what is it, 15 to 20?
It's 0 to 20, and it's all based on your tax bracket based, and this is long-term capital gains. So you have 3 categories of capital gains that you're talking about, or sorry, 3 categories of taxes that you can potentially have to deal with when you're selling a property. So you have your regular taxes, which is your standard capital, your regular ordinary income taxes. So you pay taxes at whatever rate you pay your taxes at. Then you have your capital, and if you sell a property in less than a year, it's going to be taxed at whatever that rate is.
Yeah, so that's your, like your,
That's
as
your-
though you're like earning the income.
Yeah.
So it's like earned income. And the problem with that is in addition to paying federal government, now you have to get into social security payments, like your earned income. If you've ever received like a payroll check and you have that gross amount and then you have all the little things underneath, all the little things underneath is all the extra junk you have to pay if it's considered active income.
That's why you hold on for at least 2 years. Always.
Correct.
It's an investment.
Well, at least a year to get from one category to the next. So the first category is, you held it for a short period of time, consider less than a year, and you're paying ordinary income taxes. You cross over a year, now you're in the long-term capital gains tax rates, which is anywhere from 0 to 20%. And that's all based on your income level. And at 20%, you're a pretty high income earner. So, a lot of people pay somewhere between 10 and 15.
So I think the 15%, the way I understand it, is husband and wife up to 500,000 is the 15% bracket, or somewhere right thereabouts. And this changes from year to year. So these aren't kind of things we tell our clients, right? These are just, we're trying to understand the concept, and those numbers will change from year to year. So you constantly just tell your client to look them up or send them a link on the internet. Don't ever tell them what their tax code is going to be, because their personal circumstances and what they have going on the rest of their estate, you may have no knowledge of. All you can say is, look, here's a hypothetical. This is roughly what we see most our clients incurring. But everybody's circumstance is going to be different. So you never want to make sure you're not giving that kind of advice. You're very clear about that.
Just tell them to go talk to their CPA, right? That
Well,
would be the script.
You want to have
I'm not talking about it.
so the thing is, this whole class is designed to give you the knowledge that you need so you can have not a CPA-like conversation, but an educated person on taxes-like conversation. So you tell them, hey, I'm not a CPA. So you're going to want to consult your CPA with everything I'm about to tell you. But this is how the process works. This is what you can expect to happen. Now, it may differ slightly based on your situation, but this is the overall kind of how it works. And then we can put together a strategy based on how it works and what you want to accomplish. And then you take this strategy, go to your CPA and make sure everything looks good.
I have a question for you, JR.
Yeah.
Out of, say, 10 clients that you have that conversation with, how many of them do you think actually go to a tax attorney, CPA, or anybody else for coaching advice?
Absolutely none of
Jackson, can you open up?
them.
None of them.
Absolutely none of them.
So none of them. So this is why it's so important. As soon as you tell your client, hey, go talk to your tax attorney or your CPA or your other advisor, and they'll tell you if it's a good idea to 1031 exchange or not, you've already shut the deal down, because that has created a barrier between you and a real estate transaction that you can't control, right? You can't control the conversation, you know, which is why it's so important. If you're going to work with investors, you got to at least have a working knowledge of the 1031 exchange, the taxes that are involved in it, why it makes sense to do a 1031 exchange beyond just, hey, you save money, you know, and I want a real estate check, right? I want a commission check. So,
And this type of conversation can even help you when you're helping someone buy a property. Because when everybody thinks about they're making an investment, especially in San Diego, you're not typically going to get what when you make a rental investment in San Diego? What's the term that you don't typically see in this market? But if you go to the Midwest in the middle of nowhere, you typically see
cash flow.
cash flow.
Cash
Cash
flow.
flow. Yeah, so you'll cash flow. You'll actually net some profit monthly from that investment. Well, a lot of folks, when they're thinking about, hey, should I make a real estate investment? They're looking at that term, that specifically. Well, in this market, what you're not going to get, you're not going to get that. So anybody making a real estate investment in San Diego has to be looking at something different. And so the other things that you get out of a real estate investment are you get tax benefits, which we're going to talk about a lot today with the 1031 exchange. And then you get the value of appreciation. You get the value of, the amortization of your loan and the loan pay down. You get the value of appreciation of rent. So while you may not see cash flow today, you may see it in 5 years. So when you bring all of these conversations together, this can help you when you talk to someone about potentially selling a property because they're worried about paying too much taxes when they sell a property, or even can help encourage them to purchase a property if you can have this complete conversation.
Depending on their age, I think one of the biggest benefits of trying to get somebody like the baby boomers to sell a home that they spent 200,000 on in the 70s is to say, look, your children, I believe, won't be taxed when they go to inherit that property. I think there's like this, I don't know if you'll go through that, but I've already looked into that.
Oh, that's awesome. We should, while we're going through the benefits, so.
It's already defined, but it's like, would you be the.
So-
I'm sorry, what you're saying?
Okay, so there's that term that you mentioned, that you're exactly right. There's what we call a step up in basis. And so that's a tax conversation. That means that when you pass away, that's part of the tax code. That's part of the loophole, right? That's all these things that we're going to describe today. When you talk about, the ultra wealthy take advantage of loopholes in the taxes, right? They're not doing anything illegal. All they're doing is taking a written tax code and they're using it to their advantage. They're intelligently taking the tax code and using its proper interpretation to create a situation where they're creating an opportunity for themselves that the general public, unless you're educated about these things, just don't know, right? So when you become higher net worth, you start consulting with people who understand higher level strategy. And that's what we're talking about with 1031 exchange. This is a higher level strategy. Right. And when we get a little further, I'm going to bury it with a little higher level stuff, but I want to finish going through. So from a benefits, so we've got step up in basis.
It's being reported.
Yes.
What are the other benefits? What are the other reasons you do a 1031 exchange?
You're increasing your ROI, right? If you're moving money, right? Either appreciation or more passive income.
Right.
It's the same.
Are you guys familiar with how depreciation works on assets, or more specifically real estate?
So about 27 years or something.
Yes.
Yeah.
Get them, Jared.
So when you own an investment property, you are allowed to depreciate that asset, the actual physical structure itself, not the land, but the physical structure itself, over a straight line period of 27 and a half years. And typically, when you're doing one of the big tax benefits of owning an investment property is founded in that depreciation aspect of it. Because not only can you write off the interest that you're paying on the mortgage with no limits whatsoever, you can write off obviously all the maintenance that you complete on the property. You write off any sort of HOA fees, which is not something you can typically write off on your personal property. So any sort of expense associated with that property, you can write off, with the exception of the principal payment that's in your mortgage that you're paying. But all other expenses you could write off. And then on top of that, you get to write off depreciation. Now, depreciation is just on paper. So say you collect 20,000 in, rental income for the year. Typically, once you start adding up all the stuff that you're going to write off, you may show a negative number on your taxes as far as how much you netted from that particular investment. And now you have a passive loss that we'll talk about as well, that you can either carry forward, or if you're a real estate professional, you can likely apply to offset your actual income. So taxes is a major component of why people buy rental property. And it's a major component that the newbies don't think about at all when they're thinking about buying a rental property. And so the 1031 exchange is a major aspect of that, because it allows you, when you eventually sell that rental property, that you don't have to pay the taxes on the sale of that property at that particular time. And if you keep doing 1031 exchanges, you never have to pay the taxes. You die, the basis steps up, and then you pass it on to your loved ones.
And then California, I think, didn't they just pass something too recently for people over 65 that if they want to sell the current home that they're in now, put it in a 1031, they're going to keep the existing tax rate that they were at for like the prior years, instead of paying 1.9 on like a $2 million home that they're going into, they're keeping the tax rate from the old home.
So, yeah, so you're mixing two different things. So what you're talking about is related to property taxes
Yes,
and the property
yes.
tax rate. So we're talking
Yes.
about
Yeah.
IRS and California FTB taxes. And what you're talking about is
Yeah.
property taxes. So specifically, so remember when we started off this conversation, we were talking about, we were going through the different categories of how you pay tax
Sorry,
when
I
you
just-
sell a home. We say, hey, if you sell it within a year of holding it, you'll pay ordinary income tax. If you hold it for over a year, now you're in that long-term capital gains rate, which is going to be less, at 0 to 20%. Then if you live in the property for 2 out of the last 5 years, you can sell it tax-free up to $250,000 if you're single, or $500,000 if you're married. So those are like the different things. And then inside of now, obviously, we're talking specifically about 1031 exchanges. So this does not apply to a property that you actually live in. So this conversation is specific to properties that you have and you own
Wouldn't
as
that be
investments.
an incentive to talk to your baby boomer client who's nervous about moving because now they have to pay higher property taxes?
The 1031 exchange?
Well, so the incentive is if it's, 1031 rate, but also I thought there was this new law now where they can stick
Yeah.
with their own.
That's,
sold property
yeah,
tax.
but that's separate. I mean, so
Yeah.
that's a different nuance where, and it's a state of California thing. It's not federal, right? So this is specifically in California between counties. So before it used to be you'd get permission within the county.
Oh.
And your county is the one that's calculating your property tax. That's not a federal level, right? That's county specific. So that property tax, the county was designating who could and couldn't move their tax base.
Right.
So the California thing, that the law that just passed made it so that you have the ability to move your basis between counties, right? So it used to be only between the county or between
It was like 13
cooperating
counties that,
counties.
cooperated throughout the city.
So, but now
Yeah, throughout the
everybody
state.
sounds like is cooperating.
Yeah,
But,
and so basically, and it used to only allow them to do that one time. Now they can do it up to 3 times. And so basically, if they bought a home back in the 60s,
Right.
at $150,000, their
They're
property
paying
tax is based
$1,000
off of,
A year for
the-
taxes.
yeah,
And then they want to move to $1 million home because they have all that equity. They won't be paying property taxes on $1 million home.
It
which is
does.
Another beautiful thing.
It
that
makes a
we
lot of
should
sense, yeah.
know to-
Yeah.
Which they would know. I would think.
Right.
well, I mean, some
You
people
would
don't.
know.
Some people don't pay attention to that stuff. So it's good for you to know. And then you
Yeah.
pick out the information that's applicable to the client at the time.
You mentioned HOA, does no breeze count as well?
Okay, so it doesn't get depreciated.
Not depreciated, but it does count if you're paying those on investment property.
Right.
It's part of your taxes. That's an investment expense.
It's
So you can write that off. totally.
against your income. Yeah.
Okay,
So and we'll get into more detail on that. That's kind of some nuances with investment. But hopping back to the depreciation conversation, so the,
27 years. Like,
Yeah,
go
so
back
we've-
27 years.
yeah, we've got 27 and a half years is that you basically are able to depreciate it. The reason the IRS did that is when that code was put in place somewhere, they picked up this number 27 and a half years and decided that's how long a house lasts. Right? 27 and a half years. So if you build a house today on top of the land, that in 27 and a half years, that house will be valued at zero in IRS terms, right? But we know houses last a lot longer than 27 and a half years, right? But the good news is that you get to depreciate it faster. It's kind of like if you think of a car when you purchase a car, right? Well, it doesn't, its value drops, but that's different than depreciation, right? So when you purchase a car with regard to your taxes, typically a car that you're using for business, you can write that off and deduct it as an expense, what, over 3 years?
For
Typically,
business, it depends on how you want to do it.
three.
You could do it
But if you
5
have-
years. 5 cars, 5 years.
Car's 5 years, right? So you're taking the value of the car over 5 years and writing it off, even if there's still value left at the end. But you're using the value of that vehicle as an expense against your income and claiming it to be an actual expense, even though you haven't had a physical, I mean, you may have paid the cash up front, or maybe you have a 7-year loan with a balance left on it. But the IRS has allowed you to offset your income with that amount over the 5-year period of time. If you may recall that there's some conversation about a vehicle being deducted or depreciated in the current tax year, if it's like an overweight vehicle, like over 6,000 pounds, then as like a business truck, they'll let you depreciate that whole amount of that car in your current year. So if you buy a $100,000 car, you go get yourself a Tesla and you have 100,000 in income, you write that off, you have 0 taxes for the year, right? Which is cool. Now you've got a car and you don't pay taxes. If you were to,
And a caveat to that is I don't know if the Tesla qualifies, because I don't know if it's heavy enough.
the big one does.
The big one does. Okay.
Yeah, I love it.
But like typically it's SUVs, trucks, etc.
In this case with depreciation, you're 27 and a half years. Now, here's the trick with it, is that it only counts on the structure. And here's this is why I got JR here, because maybe he'll know the answer. I know the county assessor does assess the valuation, the estimated value of the structure and the land. Is that where the IRS takes the number from?
Nope. As long as you make up a reasonable number, that's what they use.
There you go, reasonable number. Okay, so
And so like condos, most of the depreciation is gonna be what you paid for it, because you don't have much land. Versus a single family home, you have a plot of land that you need to factor in. And again, that's a CPA conversation, but
it's a high level conversation, obviously.
yeah.
But let's say, for example, if let's say 50%, we know the land value in San Diego is pretty high, right? So if the structure is 350,000, that's what you're depreciating over the 27 and a half years, right? So you buy a 700,000 structure, let's say 350 is the structure, 350 we consider the land value, right? You depreciate just the portion of the structure against your income, right? So it's not cash you get from the IRS, it's just offsetting the rent. You write it as an expense, even though you're not writing a check for it. It's not a real cost. It's just offsetting the income. So let's say, for example, an investment property that you have that you're renting out brings in $12,000, or in this case, what, 350,000 over 27 and a half years comes out to, what is it? 12,757. I just ran that number. That's why I know that. I know I was trying to look like a savant. I'm not a savant.
It's not algebra. Just kidding.
Yeah, but it comes out to a little over 12 grand. Okay. So if the rent you're receiving are 12 grand and you have this depreciable expense, which isn't really an expense you're writing a check for, of 12,000, then that 12,000 in rent you've taken, put it in your pocket, it's not taxed. That's pretty cool. Make $1,000 a month and not pay, $300 in taxes, because the taxes we said are 20%, and then there's a 13 28.3% in the state of California. So you're real quick at 28.3.
Yeah.
If you're,
And this actually offsets your ordinary income tax, which is the highest tax bracket of all those different types of taxes that you could potentially experience. So this is offsetting that higher income. So this is why people will depreciate that property while they're owning it as a rental property. And then there's another layer of depreciation if you want to get real sporty, what they'll often do with like apartment complexes, where they'll do a cost segregation study, and then they'll go even deeper than land versus structure. And they'll say, okay, well, what's the makeup of this structure? And what's a 3-year asset? What's a 5-year asset? What's a 7-year asset? And what's a 15-year asset? Break all of the costs of those down and accelerate the depreciation even faster so you can write off more money every year.
typically when you start playing with, once you get up into higher cost structures, when you get up in the 10 million, 5-10 million range, then all of a sudden it makes sense to have somebody, to pay somebody to break it down into your individual, like refrigerators all have a shorter use than the structure.
Like
Right.
carpet, carpet is 5 years. Like they break out all the carpet. You got, if it's a, 40 door apartment complex, there's a lot of carpet in there.
Do you guys know what a capital improvement is?
Property that is over what, $2,000 each.
I don't think there's an actual fixed dollar amount, but you're right. So a capital improvement is you investing in the structure in some way that is a long-term type of expense. So for example, mowing the lawn or having a maintenance guy come and trim a tree, that's not a capital expense. That's just ongoing maintenance, right? Is it roof?
Roof, HVAC system. Like items like that, add a patio. Yeah. I can't remember exactly where windows fall, but it probably is a capital improvement. That's fairly substantial.
Yeah, and the difference between, just a second, Doug, the difference between a capital expenditure and maintenance is maintenance hits your profit and loss in the current tax year. Capital improvements where you're putting large chunks of capital into the property then get depreciated over a longer period of time.
And they all have their own.
And I don't
specific
think solar
numbers.
or windows, because you may have liens on them, they're not paid off. They still belong to the companies sometimes, when you go to spend $20,000 on windows and you're leasing them
No.
in a sense.
Okay. I'm
I
not
came
sure.
across that
Yeah,
before.
I'm not sure.
Definitely with solar.
So that's where again, we're referring people back to the tax professionals. That's after we've closed the deal and they're dealing with solar,
And the
right? We got
sellers
paid.
Deal with that too.
Yeah,
and they
so,
know
yeah.
too.
And then Doug,
I replaced a shower in my rental unit upstairs in my complex, and I talked to my tax professional. It was $3,000. I said, because it was a replacement, that it had to be a capital improvement, so it had to be depreciated. Whereas if I repaired it, it would be capital what? It was some sort of rental expense that would be deducted directly off your tax year. So it's always a benefit to have a rental expense in the deduction to get it. So repair is better than replace.
Yeah. correct. So, okay, so we went over deferring tax on gains. We talked about step up in basis. So when you hold a property from an estate planning standpoint, you get this automatic step up where when you pass and it goes to your kids, all this, all the valuation and all the depreciation and games that you've been playing pretty much gets cleaned off. And the value of the property starts over at the current value of the property at the time of death. We talked about how we defer depreciation for recapture. Did we go? I guess we didn't go over that yet, or did we a little bit?
Well, I just wrote it on the board because we were kind of talking about depreciation. So obviously, when you depreciate a property, when you own it, when you sell it, you have to recapture that on the sale of the property. So remember, we were talking about different buckets of taxes. Depreciation recapture is a 25% bucket. So it's slightly higher than that long-term capital gains. So say you had like, I don't know, say 10 grand of, that's probably a low number. So let's say 100 grand of depreciation over the life of the property. And you made $300,000 on the sale after you adjusted the basis for any sort of, improvements and things you did to the property, any money you spent, any cost of the sale, you adjust the basis, the cost of the property, you bump that up. And then whatever you sell it for, and then the difference is profit. So say the difference was $300,000. but 100,000 of, well, over the life of the property, you had $100,000 of depreciation. So now you have to look at that $300,000 and say, okay, well, how much of that is capital gains and how much of that is depreciation recapture? So now 200 grand of that will be taxed at the long-term capital gains rate. The 100,000 will be taxed at the depreciation recapture rate, which is slightly higher. That's one of the downsides to depreciating it. But if you do a 1031, you get to avoid the downside. And then to go another layer deep with that, if you do that cost segregation study, part of what you're doing with that study is you're turning items in the home from real estate structure into personal items. And the depreciation recapture on personal items is at your ordinary income level, which you remember, that's the highest tax bracket of all the different brackets that you could potentially be in. That makes sense?
So you talked about these buckets like before, 45 seconds, no, over that last
All
one.
right, so ordinary income,
Personal,
this is personal.
Yeah.
This is tax. This is 0 to, I think, 37, I think it is. This is less than 1 year. This is 0 to 20. Long term. Got depreciation. Capture. 25%. That's not- 25%. Got personal property. It goes back to this is kind of, so this is what I was saying. So anyway, so the whole point of this is taxes can get confusing. You depreciate so you can write off and take benefits from owning that investment property. That's one of the major benefits to own an investment property is this extra little write-off that you could use. Because usually, even if you're cash flowing on a property, this will allow you to show a loss on paper. And as real estate agents specifically, losses are fantastic for you on paper because they directly offset your income, which is your highest tax bracket. So you get a loss from your rental property on paper, not even a real loss. You actually put money in your pocket over the year. You get to offset this income, which is your highest level of taxes that you're going to pay as a real estate agent. Now, as a regular investor, they may not get to write off the losses of this income. It kind of depending on how much money they make, but they do get to carry forward those losses into future years until they have gains on their rental properties that they own. So we carry forward this kind of faux loss until eventually there's not enough faux to write a loss and you actually have to write a gain and you get to wash those gains away. So that's the value of owning rental real estate. And the 1031 is kind of like the capstone to the value because eventually you got to sell it. And the 1031 will allow you to take all of these benefits and instead of have to pay for it at the time of sale, you just push it off into the future.
and there are people of all ages who do 1031s. You're not just talking about the baby boomers. I've had friends who are like 35 who, sold something in San Diego and took the 1031 to put it in Park City.
Correct.
How long did they own those assets?
10 years for the Ditmar home.
Okay.
South Ocean side,
Mhm.
just sold last
Awesome.
year and bought a fixer 1.2 in Park City.
So I know I mentioned non-technical. That was,
Not tax.
yeah, I kind of mentioned non-technical for today, but I kind of lied a little bit. I put together a little spreadsheet.
Before we go into the spreadsheet, can I interrupt?
Yeah.
Please. So with the years, you said like 2 of the last 5 years, because I have an investment partner, I'm gonna go to the listing appointment on Sunday, and he wants to do a 1031 and move it to Indianapolis to buy some commercial. So we just like, I have to talk with my tax guy to see if it's right off the cutoff of when he's lived there. So can you just elaborate a little bit? Was it 2 of the last 5 years? You just have to be in their property for at least 2 years, even if you go in it for like 10.
Yeah, so you're mixing up two different things. So if you lived in a property 2 of the last 5 years, then you can treat that as a personal property
Primary.
and you sell that normally, not through a 1031 exchange. And then you get to write off $250,000 of the capital gains on the sale of that property, or it's basically tax-free if
per
you're
married.
single.
Per-
Yeah.
right.
Yeah, if you're
500
single,
if you're-
and 500 if you're married.
Okay.
So that's selling
That's
basically a personal property or owner occupied property.
And
or
that's
a-
the 2 out of 5
2 out
year
of 5.
conversation.
That's the 2 out of 5. So I'm confusing that with the 10.
Okay, the
Yes.
1031 exchange, how long does it property have to be an investment property to do a 1031 exchange?
Typically, they're looking for like a year.
12 months.
Okay.
12 months.
Yeah, because they're looking for it to be a long-term investment, not a short-term investment. Because if you're like flipping properties, that's considered ordinary income. So it's just like you selling real estate. If you're
But-
flipping properties, that's just part of business income and it's treated as such.
99% of the time, if you have the option to treat a property as personal property and not use a 1031 exchange, take that $500,000 deduction to pull your equity off the table.
That's a better option.
99% of the time, that's the way you want to go.
Yeah.
So if you can pull off, I have lived in it 2 of the last 5 years, or somebody's coming up on that cutoff of 5 years and they've been in 2 years and they're like, what should I do? You're like, unless they've got substantially more than 500,000, free up that cash, put it in the bank. It's liquid. You don't need to do a 1031 exchange and lock it up. But if you do, if you're looking to leverage 1030, you're looking to leverage investments. And what I mean by leverage is compound them. Meaning you start with a little something, we take the equity, that little something we invest in and rent out grows, right? To the point where all of a sudden now we can do more with the equity in this asset than the asset is currently doing for you. And that's the point we want to unlock that equity and move that equity to a new asset that gives you a different tax situation, a newer, more advantaged tax situation. And now we're starting with, instead of starting with this that's growing exponentially like this, now we move that to here that's starting like this and it's growing much faster. So you actually, that's how you really accelerate or leverage your growth.
And there was a KW, like 11 o'clock, Colette was talking and they mentioned a really good book called Tax-Free Wealth, which she recommended like all agents should get. I haven't
Yeah.
read it, but I don't know.
There's a lot of, there's a lot of resources online and I reference them all often. So nobody can keep up on all these codes and tax things, but
Just a few key.
there's so much just to understand kind of the inner workings enough to be able to coach your client on here's kind of how it works. Then you can go online or put your client in touch with a resource online to do their own research if they really want to dig on it. When you get into some of the nuances, I'm always going on to double check to make sure, because things are changing and oftentimes we don't even hear about it.
You guys on Bigger Pockets?
Yeah.
Great.
Yeah.
Top.
Yeah, it is. That's a great place to go get information too. Check and make sure that the numbers you're using are current.
Bigger Pockets.
Yeah,
It's
I
a game
checked
changer.
What is it, a website?
biggerpockets.com.
Yeah.
It's an investment platform. So it's a place where investors
Yeah. realtors,
frequent to
investors,
find homes. To,
out-of-state, lenders, just really great topics,
Mm-hmm.
flippers, rehabs, just.
And to amplify on what you were saying, so like, we're talking about 1031 and kind of amplify what Jack was saying and pull them together. You start off with a $400,000 investment property. You let it grow over time, then you take that equity and you move it into a $600,000 property. Now, this is assuming you never even put any additional money into the property. You just take and move, take and move, and take and move. You do that long enough, 10, 15 years, you might grow substantially, especially in this type of market. And now you have this property that you started with, say 20% down loan on a $400,000 property. And probably by the time you get to here, you're almost probably paid off on that loan. So now we're talking about cash-free wealth. If you take a HELOC or a line of credit or a cash refi out of that property, none of that is taxable. You can take that money out, go spend it. It's not taxable.
Is it taxable?
No, none of that's taxable. It's taxable when you sell the property. If you pull money out of the property in some form of a loan, that's tax-free money. So that's also a value of 1031 exchange. You're basically just growing a potential bank account, you can turn it into a HELOC and then use that to make all kind of investments, and it's all tax-free.
Yeah, so I, just trying to figure out what to have a conversation about in here with 1031 exchange. It's really helpful to kind of hear the concept, but to understand and actually see the numbers. I don't want to get, the purpose of the spreadsheet that I built wasn't to get granular into the month to month, but to show just the trend and how there are some very real inflection points in a real estate ownership on an investment that translate across to these things that we talked about with the taxation, the depreciation, how you're carrying forward losses on an annual basis. There's a point that those tax benefits expire. And once you cross that point, you were heavily into taxes in a way that you weren't just prior to that crossing that line. And so every owner's situation is different. So there's no way to be certain when you're talking with any one client that they are before or behind the line. But there's definitely a point that you get to in most markets. In our markets, it's like the 10 to 15 year mark. And once you get past that mark, there's better things you can do with your money, right? So I put together just a hypothetical purchase, and I took a property, let's say 700,000, so 700,000, let's say 25% down. If you guys don't know, 25% is roughly what you need to put. I mean, that's the minimum in most cases you put down to buy an investment, right? So your average Joe comes along, wants to purchase something, and that means you're financing 525,000. So it's reasonable to assume that you're going to get 2,800 a month in rent and monthly rent on a $700,000 property, right? If you buy something in East County or something in Mira Mesa, single family home, you can pick up something 700,000, right? Then let's see, scoot over here.
I was trying to make this go away, but I couldn't figure out how to make that go
Oh.
away.
The minimizer?
Well, I minimized there, but it didn't minimize here.
Okay, well, I'll have to be conscious to move it over enough. So the monthly cost, so we've got principal, interest, taxes, insurance. So are any of these not tax deductible against your income? Yeah. So that's the only thing that's not tax deductible out of those numbers, right? Because everything else, if you think of an investment property, instead of thinking it like real estate, think of it like a business, right? So if as far as the IRS is concerned, a rental property is a business. So any real expense related to that property, you can deduct, right? So if you have to pay for lawn mowing, it goes right against the rents. If you have to, replace the roof, it can be depreciated over time as a capital improvement. But those are all real expenses you get to offset against your income. So in this particular case, we've got, I just assume the interest at about 3.5%, which is current. That's what's going on roughly for investments right now. The taxes, usually 1.125 in most of the county. Insurance, probably about 120, just a guess. I didn't look it up anywhere. So you're looking at about 3133. We know the rents are 2,800, so we're running at a loss here, right? Which is also normal for San Diego. Welcome to San Diego. If they don't want a loss, they have to put more cash down. It's just how it works, right? But the numbers also work out better here. And I'll show you why. But we'll get to that in a minute. So from a tax assessor, these are the assumptions I made at a $700,000 purchase. Half of the property is depreciable as a structure. Half of it is the land, right? I don't know how accurate that is. I made that up. So JR probably would
I
tell
would
you.
skew more to
could
the structure, less to the land, but it's, because
say-
I mean, you talk to your CPA and see where they think. I mean, I would probably start with the property assessor's office and see how they looked at it and what the percentage difference. And if you're close to that, I think that's reasonable.
So this is the number. This is the 27.7 number that made me look like Savannah a minute ago. That's why I knew it, because I'd just done it for the spreadsheet. Yeah. So, I mean, we know how properties appreciate. I don't have to teach any lessons on that, right? We made an assumption at 4% gains, right? Pretty conservative, given what's been going on lately. But that's statistically, it's been between 4 and 5% for the last 30, 40 years in San Diego County, given all the ups and downs, right? So if we take a look at this, we see the equity gets up here, once we get into the 10 to 17 year mark, the equity starts getting way up there. But the real part of the picture that makes this enticing is what's going on with your equity. And there's two things that contribute to your equity gain. One of them, of course, is the property value increasing, but also you're paying down your principal, right? At a clip of, your principal, let's see here.
It was like
Your
around
principal.
800 or so, yeah.
Yeah, right here. So this is how much principal you're paying each year, right? So $10,000 you're paying down in principal. So that being said, there's, the big conversation with economics right now is inflation. Does inflation make an investment like this better or worse?
Temporarily, probably.
20 times better, way better.
Yeah, way
That's where
better.
you want to be, is in real estate.
Do you know why?
Because real estate is inflation proof.
How about this scenario? You're right. But how about this example?
Well, okay,
I'm curious what he's writing.
I was gonna say, well, that if
So-
would increase your property value, then you can sell it and have a higher gain. I don't know.
Yeah, that's part of it.
And then you're not.
It's part of it.
I want to know the boom,
Yeah, well,
Yeah,
the
tell
boom
us.
to me,
because those first two are spot on, but
the boom to me
lower value.
is if you think of the mortgage you take out to finance this property, when that's fixed, right? So that's fixed. That net doesn't get to go up with inflation. So when inflation hits you at 10%, the value of the property rises because now as everything in life gets more expensive, so a loaf of bread costs more, a gallon of gas costs more, a car costs more, a house costs more, the rent you have to pay more. Everything accelerates faster. So when you have inflation, your rents grow faster. Right? But what stays the same?
Your payment.
Your payment. So what's happening is the bank is getting screwed. That's what's really happening. But they made the deal. I don't feel bad.
Yeah, exactly.
They made the deal. They made the deal, right?
Fannie
But that's the big advantage of like a 30-year fix when you have inflation. I'll tell you, inflation is not anywhere close to what you're reading in the papers, just so you know. It's at least double. They're saying 5, double it. And I know that because look around. I mean, look around at the cost of housing.
The cost of orange juice.
Everything. Everything has changed. I just went to get a burrito, a breakfast burrito this weekend,
$11.
and it went from 7 to 11 overnight.
I love my breakfast
And I
burritos
bought
too.
it. And you know what? I'm going to go back on Sunday and buy it again. That's a 30% change in my breakfast burrito. That's a lot. So where's that going to play out in this situation? Do you want to know why property values are going crazy and people keep investing even though the property values go up? Where else can you put your money? You're going to buy gold, put it under your bed?
Not gold, but Bitcoin.
I mean,
Just kidding.
well,
You can.
that's a whole separate
The stock
conversation,
market
and I'm a
is
proponent,
well.
but there's
There's
good reasons to.
And even though like, so it's like buy and hold versus like trading, so you buy AT&T, but you have like a 7% dividend every
But-
month.
but
you're
see,
getting. But that's.
The difference with
this
that
is
is,
different than-
see, if you buy something other than real estate, you get the benefit of the higher value. And that's the only benefit you get. With real estate, what's the Fed gonna do when inflation goes up? What do? They lower the interest rates. So you're gonna get a lower interest rate. And then what happens to the dollar when inflation goes up? It gets devalued. So when you lock in that fixed 30-year mortgage on this value that's going up at a lower interest rate, you get to benefit from all of these assets, because that $3,000 that was going to cost you to pay for that mortgage 5 years ago, fast forward 5 years, $3,000 is much easier to pay. It's not that big of a deal because of inflation.
If you look around globally, the real estate here in San Diego is extremely affordable. And I know that's difficult to understand being here, but if you go to, what's the tech hub of China? What is that? It's Shenzhen, not Shanghai, Shenzhen or something like that. Did I have that right? So I was reading an article that the cost of real estate there is 43 times the value of the average area income.
But I also.
That's
heard
insane.
that they didn't have enough
43
people
times the
for
average
that market, and so the homes were actually sitting longer.
Well, they've got problems we
Yeah.
probably shouldn't get into here, because we got to get back to
That's-
1031
that's-
exchange, but
maybe that's that.
Well, I don't want to keep you off your top. I would just say, so where, I don't own any investment properties that I plan to, I just don't want to spend more than $500,000 on like a condo here, because I'm looking for more like passive income. So where versus appreciation.
right.
So where are you guys investing?
Well, depending on what your,
That's what my goal is.
yeah, depending on what your personal
Yeah.
investment objective is going to determine where and how you invest. Right. So appreciation, your growth here in San Diego and California, likely going to be faster once you get past that profitability point than in other places that don't appreciate the same.
Right.
But you'll get better cash flow in other places.
In Indianapolis.
Right. Yeah. So there's other areas. I mean, there's not a bad place to invest. You know, the reality is that if the numbers work when you invest in it and it's a long-term hold for you, the numbers play out because the tenant's paying the principal. In this case here, we're getting the equity through asset growth. Right. That's where you get most of the income here. So
I mean, and then like you fast forward 5 years, then you start to get both. Because now the rents have gone up. Look, think how much rents have gone up in the last few years. So the rents have
It's like
gone up.
split hair with the mortgage almost. I
Yeah.
mean, really.
And so you get to lock in that rate, and then now you get to benefit from the rent appreciation. And so, fast forward 5 years, you actually probably can get cash flow here in San Diego. So it's just what's your situation? What is it that you need at that particular time? Even a lower down payment and immediate cash flow, we go somewhere where the properties are $100,000. Buy a $100,000 property and you build from there. You can still 1031 it. Now, one thing we didn't even get into yet, we've been talking about why 1031 is important. We didn't even talk about like how you do a 1031.
does that even matter?
I just,
We can
yeah.
talk about that next week. I love this stuff. You have a class on this every Thursday, and I would be here.
We had a guy here.
Your brother's here. Oh,
Oh, yeah, right.
the other Doug.
It's like, just-
We had
It's just like the guy over.
It's a mirror image. We had a guy in here about 2 months ago who did a 1031 presentation. He was really knowledgeable. I can't remember his name.
He was real good. I saw it too.
Yeah, it was really amazing. And he said that the Biden administration is thinking about changing these rules up, and
That's
it's
out.
it's
That
out.
plan is over. Yeah.
Okay, good.
That plan would never pass because.
Yeah,
they all-
there's,
they all-
you can't. It's like going to baseball team and say, hey, guess what? We're playing football now.
Yeah.
It's like, there's just too many changes for them to digest.
It's
Yeah,
the
exactly.
answer.
Yeah.
It's a 1031 faster.
And I would say there are a couple of things that you want to know. Your buyer, your seller needs to, or I guess your seller needs to institute or put this process in place before the close of the sale of their home. They can't decide to 1031 it after it's been sold.
So, okay, so to talk about the mechanics of it, a 1031 exchange involves an accommodator, which is simply just a company that has a trust. This is the only thing they do is they're just an accommodator. And when you sell the assets from the sale of a property, those assets, the cash from that, the equity goes to the accommodator and he just holds it until you find the new property, then puts it in there into the new property. And they do that to prevent you from touching the money, right? So as soon as you touch the money, it's considered boot. So that's the term for it. It's called boot. Once you touch the money, it's taxable, right? There's also timeframes involved with that transition, right? And you can look those up online, no need to memorize them. I've got guidelines for 1031 exchange. If anybody wants them, you guys feel free to email Sheila. You can email. That's not. I'll put her email address up here.
And if you're working with buyers that are doing a 1031 exchange, just remember that identification of a property time frame is actually for you as a real estate agent, get them into escrow time frame.
Isn't it like 45 days, basically,
45
they
days,
have
that's
to do the exchange? I
They
thought?
have 180 days to close an exchange. They have 45 days to identify the property.
Ah, gotcha.
But the way that applies to you in San Diego That means you have 45 days to get them in escrow because they can identify, there's limits on the number of properties they can identify 3 properties, and then there's like a couple other options where they can do more. But regardless, in San Diego, just know you got 45 days to put them in escrow. It's not just identify the property. You have to put them in escrow if they're doing a traditional exchange. The other option is they could do a reverse exchange where they buy the property first and then sell their property. So that's something that you may want to suggest to them if they have the cash available to do a purchase independent of a sale. They can do it in a reverse order. And obviously it makes that identification period less stressful because you don't have to worry about, only having 45 days to find the property.
What qualifies for 1031? Because I thought there was also a certain amount. It's not, there's no amounts.
There's no amounts.
So if I said 500,000 and then I buy $1 million, it's still.
The purchase, the acquisition property has to be of equal or greater value than your departure property. Right, so you just have to be moving up.
And that's just so
You can
you
move
don't
lateral.
pay taxes on that. You can buy something less, but then the difference you pay taxes on is if you get 1031. So that's the delta.
Right.
As long as it doesn't matter if it's higher, as high as it can be, it doesn't matter.
It just has to be like kind, which doesn't even mean it has to be from a single family residential to single family residential. It just has to be similar. It can be residential to commercial, commercial to residential, and then there's even other options like what's the DSTs and all kind of.
Yeah,
options.
Delaware Deferred Statutory Trust, which is, it's just basically investment vehicle where you can purchase a percentage of interest. It's kind of like a REIT, if you guys are familiar with REITs or a real estate investment trust, where you're purchasing into a percentage of interest in of a structure. So you'd buy into like a healthcare facility or building, and you'd be a percentage owner rather than being an exclusive owner like you would on a single family or a multiplex, right? And there are investment companies that are just create those vehicles to allow there to be a place for these funds coming out of exchanges that can't be placed quickly. So people run into a problem, sell a property, and then the house they were going to buy falls through. There's a place for that money to go if they need to identify. So in some cases, if I'm not far enough along in a transaction with the client and I can identify multiple properties, and you can per the IRS code, if I'm not far enough to where my client's done with the diligence, I'll have them also identify a statutory trust as well, which is a deferred taxable. It's the same thing as a 1031 exchange, just in a group type format. So at least then they won't end up being taxed if they don't want to be. They have a place to go with their money, right? So there's backup. There's a backup plan, and just know and consult with your client. Say, hey, look, if all goes wrong, just know I got a backup plan for you, and be confident it's there. And if shit hits the fan, come see me. I'll point you in the right direction. So
now, I guess 2 other things I have to mention to real estate agents in a room. If you're selling a property and a buyer has to do a 1031 exchange, what does that mean to you?
Fast. You gotta get it done fast.
It means that they have significant pressure and reason and desire to close on that purchase. So someone doing a 1031 exchange, if I'm a seller looking at potential buyers for my property, and one of them is someone that wants to do a 1031 exchange, they have a high rate of desire. They should have a high rate of desire to close.
Because they have the cash and they're ready to go.
It's
They're
not even
awesome.
about the cash. It's about what
Timeline.
they're going to lose if they don't meet that timeline and close on the property. Now, that being said, they could have identified other properties, but just remember, in this current market in San Diego, it's moving too fast to say, well, I want this one, or this one. Let me see, let me see over the next 45 days. I'll try this one and no. Like every week you got a new set of properties, like they're circling, like they keep moving. So if you have, and so on the flip side, if you're representing a client as a buyer and they need to do a 1031 exchange purchase, what does that mean?
it's a sprint.
You got a highly motivated buyer, which is what we all want on the
Yep.
buy side. So just keep that in mind.
They're awesome. They're great. So
Escrow, as a realtor, do we deal, or is it real? I thought it was escrow that deals with the 1031. Do we really?
so once you identify an accommodator, it's like shopping for any of your services. right? Your client can shop for them, but usually they're going to look to you for a recommendation because they're only use one of these things once every 15 years, right? So they're going to look to you for some coaching as to who to use and why, right? There's a company we use, it's called Investors 1031 Exchange. I use them because I met the guy personally, had an opportunity to kind of talk through the way he manages his trust accounts, individually insures the accounts and such, which is a little different. It's a little more fanatical about the way he manages things than a lot of the trust accounts are managed. Are there really big, widespread defaults on 1031 exchange accommodators? No, not really. They're all insured. They have E&O. Sure, something can go wrong, but for the most part, you just want to pick somebody kind of like a escrow or title company that you know they pick up your phone calls, they're going to do their paperwork on time, they're going to get these things done and make you look good in the process. So Investors 1031 Exchange, Sheila has that too if you guys want it. Just email Sheila and she'll send you the packet from them, as well as their contact information if you need somebody to refer and don't have anybody. But the accommodators themselves are, you know, they're real good. They just, once you connect the accommodator with the escrow, they handle all the paperwork. So it's not really us doing any accommodator stuff. So we're not hands-on with anything, right? So I wanted to share this, you know, not because I'm super into spreadsheets, I am, but that's not why I want to share it. I just wanted to point out some sweet spots. You see the yellow section here. This is the years from, you know, obviously year 1 clear through year 17. This is yellow, not because I like the numbers in the valuation section, but because when you run the numbers, these are the parts, you know, that was just the, you know, the mathematics behind how we get to this area here. And this basically shows, you know, on a, let's see here, your cash flow on a property. And this is including, bear in mind that I've factored in management. So property management fees, vacancy, assuming that there'd be a short vacancy in between tenants. I've factored in carpet and paint, those kinds of things into this vacancy management turnover section here. So we've got the depreciation, everything's kind of factored into this stuff too, but this shows your actual cash flow. So somebody buys 700,000, decides to have a property manager. In the first year, you're writing a check for $8 grand. You know, the owner is writing a check for $8 grand. Second year, it goes down to 7. Third year, it goes down to 6. You know, but you can see where this changes, right? So this is really unattractive if you're doing 25% down. So most of the people who do purchases on investments to rent out are usually 30, 35, 40% because they don't want to lock themselves into this kind of negative number. But I did want to run the scenario because it's real, right? So if you have somebody who's more comfortable putting less down, just understand typically there's a negative cash flow, or if they're going to manage the property on their own, then that knocks out a solid $3,000 or so out of this number of losses, right? So now you're down to four grand a year, which starts to be a little more manageable for most people. Then, but what's happening is your taxable income looks like this. So you're, in your first year, you're taking a tax loss, right? Because now we're factoring in the 12,727. Your taxable income is a negative 10,797. Second year, we're taking the loss here of 9,361, and now we're up to taxable loss between those two of 20. And you notice that the taxable losses accumulate over the year. So everything that you're writing a check out for just adds up, right? Until you get to the point where the cash flow starts to change. Right in here, you notice the cash flow changes, and that also, this is your taxable P&L, meaning what you're paying taxes on. So now all of a sudden you're starting to pick up some taxable cash flow in here, but it's now being offset by your losses in your first 8 years. And so now as you're making more income monthly, you're still not paying taxes. So now we're getting into the years where you're talking, even with 25% down, by the time you get to year 8, 9, 10, 11, 12, 13, 14 in here, you're bringing home like actual cash, you know, $2, $4, $6, $8, $10,000 in cash flow that's being offset by your losses that you've depreciated. Part of that's related to that depreciation number, the 27.5 years we talked about, right? Because we're artificially writing off amounts that aren't real paper. It's not real cash losses that we're taking. It's actually just paper losses.
What's column S there? That's so.
Yeah, so we can see all that. Okay. So you can see that there's this point we get to where the taxes start to get real very fast. Where this inflection point here changes your tax situation. And now you went from not paying any taxes for 10, 15 years, right? Even though you did start to get into gains until to where we're starting to pay taxes. Now, this is where the taxes actually start in this scenario. If they put more money down, all that happens is they are in this area here where they're making money and not paying taxes for longer. So you put 30% down, this cash flow losses that we show here, this will reduce, right? And then you get into gains, but they're more subtle, right? And it has to do with the way that amortization works, right? So when you have a smaller balance, you start off paying a lot of principal and a little bit of interest, or a lot of interest and a little bit of principal, and it slowly goes like this. So the less you finance, those numbers kind of shift differently, right? And then you get into where you start paying some serious taxes. There's another point that's real relevant too. So if we take a quick look here, this is a 30-year, over 30 years what happens, but you notice this is that depreciation we're taking. And that gets to the point where this is year 27, this is year 28, where we're only taking half of the depreciation. And you'll notice if you take a peek over here at what's happening with the taxation, we go from 45,000 in tax, or 17. So you notice incrementally, we're only going up a little each year in taxes. This is the tax column, by the way. So tax owed. So you'll notice that the tax owed is 12,900, 13,900. So it's only going up like $1,000, and it goes from 15 to 17 to 20 to 22. So it starts accelerating as you get right into here, where it starts jumping up at a faster clip. So, and of course, once you get past 30 years, you pay off your mortgage, you're not paying any more interest. You really are getting hammered on taxes. So you're paying $23,000 a year to make 59,000, which it's not necessary. You can actually reallocate these funds, put them into, so for example, if you took, looking at this, I decided that the most ideal place to pull out was year 14 in that example I showed. And you could take on year 14, sell the property at 1.2, right? Which at 1.2 basically get you after 6% sale fees, net you out about 793,000, which is enough to fund the purchase of a $3 million asset. So now you've moved. So what does the appreciation look like on a 1.2 asset at 4% gain versus 4% gain on 3 million? Your gains just simply double or more as you reallocate those funds into a new property. So you're doubling your growth, your expansion. Jason.
Taking your example there, you have sold your $1.2 million house. Can you, if you decided you've had enough of your beautiful Carmel Valley home and want to invest in a palatial mobile home park in Akuba that's got 10 units, can you do that as long as you have an increase in? Right.
Yeah, so they talk about this as being a like-kind exchange, and like-kind is often confused. Like-kind is just a term to mean that they don't want it going into other places besides an investment. So it's intended, this money can move from any one investment that's intended to get a return to another investment of any kind. So you can take it from a single family residence, move it into multifamily. You can go from multifamily into a lot that has no income. You can invest that money from a lot with no income into a REIT. You can put it into Delaware statutory trust. So as long as you're investing it with the intent for it to be profitable, it's still, all they want it to do is to be that same business venture. You're staying, you're just the CEO of a business venture and moving that money from one property to one investment with the intent to grow the net worth of the business into another that's intended to grow the net worth of the business. Does that make sense? So really, you can go to Hakuma if you're,
Oh, nobody's gonna judge you.
yeah,
Or 10 of them, however many you want.
and Hakumba's
Your
fine too.
gains.
I mean,
Monopolize the global home estate.
Yeah.
Be Eating fancy and be a king up there, huh?
Yeah. Any other questions? Buried you guys with numbers. That made it quite fast. I knew that's a great way to end it. Easy.
I think that was a really great point at the end there, where you took the 793 at 14 years, then went to your 3 million and justified just building your business. I think that's a great.
And it's, the whole thing is we see here, the leverage is the appreciation.
Yeah.
Right. If you go to other markets, if you took that 3 million and went east, what do you think would be different about buying in Atlanta or buying in, Albuquerque or small local companies? What do you think would be different?
Appreciate as fast, but you'd have that passive income every month, so different markets for appreciation versus depending on
Right.
what your goal is.
Exactly. So that the appreciable gain is different. It's not the same. In fact, the properties there sometimes do actually depreciate, where the value of them declines because they need so much upkeep and maintenance. I wouldn't recommend getting into those areas, right? You want the income from it to be able to cover any maintenance cost or repairs. But yes, your appreciable gain isn't there, but you want your gains to be reflected in the cash flow from the property. So if it doesn't cash flow well enough for you to achieve your income goal, then you don't want to go there, right? But you can usually get that on paper. You had a question?
Yeah, I have one personal question for myself. Bought a house in Carmel Valley back to 2003, and I paid for 750,000. And but I lived there, and after the last 5 years, I wasn't live there. I ran out,
Mhm.
and because I work in China, and I came back, the house went up to 1.8 right now. But I have a hard decision. So should I, after I move, I still have to move back, the tenant will move out. Got to evict her. Yeah, long story. But after I move back, should I sell it immediately, or should I wait 2 more years and sell the house? Because my
He knows
house
to
is
do
already
that.
more than 1 million.
Yeah, that's
Already
that's
paid
a
off mortgage, nothing.
yeah, that's a very complex tax question, but you are in a position
Yeah.
where a 1031 exchange would be very beneficial for you,
Okay,
because
so
it's an investment property right now. You haven't lived there for the last 5 years. So now the way that you can defer all of those gains is to sell it and then take those gains and move it to another
I
property.
don't have to live there for another 2 years.
No,
Okay.
no. If you do this, if you do 1031 exchange, that's for the scenario where you don't live there. Now, if you do decide to go back and live in the property, then are you married? No. So then you only get to, not pay taxes on 250,000 of whatever you made off of that
I
property.
should sell it now. And then if I buy another property, can I live there or I have to rent out?
It is supposed to be an investment. So the intent must be an investment. And most people would say,
Condo, why rent out?
the intent is that it's an investment. Now, that being said, an investment is, it could be 1 year.
Oh, okay.
It could, and then you can decide to live in your investment. But the intent is just that it's supposed to be an investment. So you're not supposed to be using it to eliminate because that you can actually, you don't want the IRS coming after you. And that's a very specific question that you definitely want to talk to your CPA about, because that's like one of those scenarios where the IRS will say, bing, 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 $1 million worth of money I need to go get. And they'll come after you for it. So that's definitely something you want to talk to your CPA about.
And I've heard kind of the 1 year thing is bantered about. So as long as you rent it for like a year after, file a full tax return with the investment income. I've kind of heard that is, in the opinion of CPAs, online, right? Everything online is real. So that's kind of what I've read to be deemed acceptable, but this is just an example. There's so many hypotheticals with conversations like this that you never can, everybody needs to go get tax advice, right? And when you get to something that serious with one of your clients, a question like that, you really, you do have to sit down with a pencil and paper and do the math and decide, does it make more sense to move into it for 2 years and then sell it for the 250,000 benefit? Or is it better to 1031 exchange it today with the interest rates we have today and the values we have today to move it to something else that serves you better? So there's just so many complexities to the question. It's impossible for us to answer.
He called the tenant first.
Yeah, and
He won't pay for 5 months.
Yeah.
Tenant still pay it.
and that's definitely a conversation worth going pay an experienced real estate CPA. Don't just talk to the one that files your taxes too. Go talk to somebody that does actual tax planning for real estate professionals.
Anyone refer me to
Yes, we
real
can.
estate?
Yes, we can.
Thank you.
Yeah.
Yeah, and then I guess I got one last plug for the group. If you don't know, we do have a property management company called Three Keys Management. You'll see the flyers and stuff out on the balcony or on the countertop. So if you do have any investors that are looking to buy an investment property that you are looking to, and they need assistance with, handling the management of that investment property, please let us know. We take referrals. We offer you a $250 referral fee, and we also make sure you retain that client for life. So if they ever say they want to sell the property, we'll get on the phone, we'll call you so you can take care of that sale.
Do they also do vacation rentals or just rentals?
This is just traditional rentals. The vacation rentals is a little bit different. Good question.
When's the next class?
Why is there an next class?
I think one future.
What would you like, what would you like the next class to be on?
Yeah, like real estate invest, just like right? It's almost like atomic habits. We have to continue to do the reps, so to get this in your brain, so
Yeah.
we're qualified to credible with our clients. I would like that, and I'd like.
We can think of something.
I'd be open to hearing what subjects you feel like should be filled.
So class that talks about cap rates, for instance, investing
Yeah.
in general, things like that.
Yeah, sounds like you guys have, experience with investing. So you
Guys
hear
have time for that?
Well,
Time is
everything
precious.
in moderation,
Yeah.
right? Everything in moderation. So,
But,
yeah, of course. Thank you guys for being here. Appreciate it.
They also get your, Excel.
Yeah, absolutely. Yeah, you can play around with it. Yeah, help yourselves out. I'm happy to share it. Email Sheila.
Okay.
So Sheila at
Maybe
campbellsd.com.
once a month or what's today's Thursday? So.
Thank you.
Yeah.
You guys don't
To the
know,
fire.
I know you
To the
have
fire.
close, right? So I'm asking.
Yeah, you're
maybe-
closing.
Yeah.
It is.
I'm open to that. What I would ask in return is if you could share some ideas that you feel like would be helpful. And then I'd be happy to source, either, I know JR is open to helping. And I'm happy to have the conversations, and if it's a topic that I don't feel like it's something we're versed at, I'll bring in other people.
Mhm.
There's nothing, truthfully, there's nothing we can't tackle.
You guys need to talk. Actually, for her situation, for sure.
Refer me to CPA.
Not even that, just, what she's sitting on 1.8 technically.
You need a good listing agent? I'm Jack. It's nice to meet you.
She's gonna put that in her pocket, but if you have those 2 condos she's looking for,
Yeah.
or, you know what I mean?
Yep, happy to help. All right, thanks again, guys, for being here.
Thank you.
Bye to you guys online.
Thank you.
So much. That was really good. I gotta go. Thank you so much.